If you're even thinking about selling your business one day, check out the Entrepreneur's Exit Playbook. It's available now in paperback, audiobook, which I narrated and loved, and ebook on Amazon.
How durable is that gross margin? Is that gross margin on one customer? Is that gross margin on 10 customers? Or is that gross margin on 100,000 customers?
The idea of your narrative is critical. And in the tech space, you want to tell a story that is genuine and truthful about your past, but you really want to get the prospective buyer juiced about the future.
Don't guess, don't assume, prepare, lead with data, and when the right opportunity shows up, you'll be ready to have an exit.
Welcome back to the Legacy Advisors podcast. I'm Kris Jones, joined by my co-host, Ed Button. And today we're answering a question every founder asks at some point. What is my business actually worth? Valuation is both an art and a science. It's not just about revenue or profit. It's about positioning, growth potential, risk, and the story you tell, the narrative you tell about your business's history and the future. So in today's episode, we're going to unpack what really drives business valuation, how buyers think, and what founders can do to increase their worth starting right now. So let's kick things off with segment one, how valuation works. And Ed, if you asked 10 founders what their company is worth, you'll probably get 10 different answers. And most of them will be wrong, right?
Yep.
So let's talk about how valuation actually works in the real world. A few of the things we're going to cover here is the difference between perceived versus market valuation, key variables that influence business value, what valuation is, the buyer and the context-specific aspects of it, the impact on timing, market cycles, and exit method. So the first question, Ed, is for you, and it is, when you're evaluating a company, what are 2 or 3 things that influence how you assign value?
Well, it's because the owner said he wants $100 million. So it's like buying a candy bar.
Hey,
you name your price.
By the way, we'll get to FOMO, but if you build up enough of it, and someone has the capital. But what are the 2 or 3 things?
Yeah, the 3 main things that I always look at is kind of the first one is 2 levels. Profitability. Is the business profitable? Is this a sale where your trajectory is growing up, or is this a sale where you need to get the hell out? And then once you get over that hump, understanding how long has it been profitable? Has the profit and has the generation of income gradually increased year over year? Is it $1 million 5 years ago, and then $1.2 million, $1.4 million, $1.6 million, $1.8 million, and then $2 million consistently grown? That's a large piece of valuation. People won't get top dollar if their business is declining. The next piece is durability of revenue. And some businesses, revenue is meaningless. One of the funny things we say in our business, revenue is meaningless. But so revenue or gross margin, whichever is the most meaningful income stream in your business, ours is gross margin. How durable is that gross margin? Is that gross margin on one customer? Is that gross margin on 10 customers? Or is that gross margin on 100,000 customers? Obviously, if it's on 100,000 customers, it's a lot harder to screw up your direction. You got to piss off 100,000 people to lose your gross margin. But if it's on one customer,
good point. Yep.
You piss off one customer, you lost all your gross margin. So the durability, very little durability. And then, depending on what kind of buyer you are, if you're a strategic or a financial buyer, this one really doesn't matter as much from a strategic buyer's side of things unless they're not in the region and they rely on your team. But a financial buyer really is going to really hone in on this piece from a value standpoint. Is the team worthy to run the business without you? So can Mr. Jones or Mr. Button walk away from this business, and it's going to continue to grow, and it's going to continue to flourish, and the investment that financial purchaser, financial buyer has made, are they going to get it back? If they're paying you 6 times adjusted or 7 times adjusted or 4 times adjusted, can they guarantee their investors, a lot of financial buyers or pools of money from other investors, can they guarantee their investors with the likelihood of success that we're going to buy X, Y, and Z company, and they've delivered it for 5 years, we expect they're going to deliver for another 6 years. And the way we're going to ratchet it up is by cutting overhead and doing this stuff. So really baking it into a formula and understanding the valuation. And when we go through the assignment of value, we're looking at a range of value, highs and lows. And we'll use any comps. A lot of private industry stuff is very tough to get a hold of that. But any comps we can get a hold of to set your bottom, set your top. But in the end, it's really...
when you say bottom top, the multiplier?
Yeah. So if you have $1 million adjusted EBITDA or $1 million SDE from an asset sale, is the bottom $3.5 million, a 3.5 multiplier, or and the top is a 5 multiplier. So when you're going through that, trying to get a range, you're doing as much tempering the seller's expectations too, because every seller wants to get top dollar. They think it's going to happen, or they've heard, oh, so and so, this company sold for 10 times EBITDA. What EBITDA? Was it non-adjusted, adjusted, whatever it was? So that leads into my question. Really, is the emotional part of it. So why is it dangerous for founders to come up with valuations based on emotions or hearsay?
Well, because it's not reality. It's not grounded in reality. It's grounded in, a sense of the unknown. Mm-hmm. And the best way to get closer to the known is to listen to podcasts like this, read books on the topic. But at the end of the day, valuation is going to be some multiple of either your EBITDA, SDE, or your revenue. And we're going to get into some more specifics about that. So I don't want to go in right now. But honestly, I think that's what this podcast is partly about, is just putting some truth and some some transparency into what the process actually looks like and how evaluation actually happens. Because all of that preparation will put those entrepreneurs that are listening, that find themselves in the position to sell their business, in an empowered position versus a disempowered position.
Leverage.
Yeah, it gives you leverage. Can you actually share with us, how does the intended exit route, strategic versus financial buyer, shift that valuation lens? So you mentioned it a lot, this idea of, strategic versus financial. Give us a quick high level on what that means. And then, what are the different lenses that you're going to be evaluated from those two?
So strategic versus financial. Financial buyer is pretty self-explanatory. It's an investment fund. It's a private equity group. It's a venture capitalist.
Family office,
roll-up strategy, whatever it might be. That is a strategic person who is going through, strategic group who's going through with, that's a financial buyer that is going through with the goals of bringing it in, making it more efficient, rolling it up, and exiting for a higher 3 + 3 = 9 or 1 + 1 = 3 type of scenario. The strategic buyer is somebody who potentially could be a competitor, somebody's in your space, but might not be in your regional space, but might be a state away. So they typically, it's funny because strategic buyers that actually will earn more add backs because they can get rid of a lot of the staff, they can get rid of a lot of the overhead and really focus on just the customer base, they'll tend to pay less than a financial buyer. Financial buyers seem to be more aggressive, at least in our space.
In the tech world, to be fair, the way that I think about it is a strategic in the tech space is going to take whatever technology or innovation I made and give it true scale.
Yep.
You know, whatever I got it up to that point might be impressive, might have had local or regional or even national impact. Company comes in, gives it all of those things times 5.
Yep. Yeah. So breaking it down, strategics are typically your competitors or people like yourselves in the space, just in a different area, and your financial buyers are your family offices, private equity groups, and in the end, when you're presenting to those people, they have different goals. They obviously have the same goal of buying your business, but there's two very different paths as they're buying your business of what they're really looking at. One thing with your strategic purchaser, like you said, they're looking at your business, and sad to say, but most likely they're gonna gut your leadership, your upper management, because they're gonna trust their group. They're gonna take your products with their leadership and their capital and explode it. In our industry, same thing. Strategic buyers are gonna buy your business, remove most of the leadership, create as much efficiency as they can, and hold on to as much of that margin as they can. They return their purchase price to them as quick as they can. And that's really the main difference. And in our space and your space. The big difference between the financial buyer is they're gonna rely on your team. They're gonna rely on the people that ran your business to where it is, and they're gonna come in typically with capital and get a strategy in place and help to grow your business. And that's really the two main differences between strategic and financial buyers.
Okay, so now that we laid the sort of, call it the frame or the framework for valuation, let's zoom in on arguably one of the most important things for our listeners to understand. One of the variables is the multiple. And so in segment 2, we're going to be talking about EBITDA versus revenue multiples and what founders need to know to avoid costly mistakes.
So let's talk multiples, because when it comes to valuation, not all numbers are created equally. For SaaS companies, annually recurring revenue, ARR, is the driver. In others, it's EBITDA. Knowing the difference is huge. Segment highlights when to use EBITDA versus revenue multipliers like MMR, ARR, how industrial norms affect multiple benchmarks, risks of assuming inflated or irrelevant comps, real-world examples where multiple misalignment hurt deals. So to start it off with, first question is, when you were preparing Pepper Jam for exit, how did you think about multiples and what drove it?
So I mentioned this earlier, the idea of your narrative is critical. And in the tech space, you want to tell a story that is genuine and truthful about your past, but you really want to get the prospective buyer juiced about the future.
The sizzle.
You want to sell the sizzle. And I knew that it was going to be an EBITDA multiple, and that's where I kind of got my grounds around even what EBITDA means and how it's calculated. But we'll put that aside for a second. What's most important is that I knew I was going to be, I was most likely to have some multiple of EBITDA. And the reason is because we were around for, 6, 7, 8 years. The technology that we launched, called Pepper Jam Network, as an affiliate network, had literally just launched the year before. So when we sold, I think it was September 1st, might have been November 1st of 2009, we had just launched the platform less than 2 years previously. But long story short, I knew I had to get my narrative right. And let me share with you how that worked. I knew that GSI Commerce, they basically provided back then the e-commerce infrastructure for high-end apparel brands, as well as all of the professional sports leagues, so the NBA and the NFL and Major League Baseball and Major League Soccer, all of the collegiate stuff. And so my narrative was, hey, look at our track record as a marketing services business, SEO and pay-per-click management that kind of thing, where we had built a really, really strong business. But by the way, look what we have. Look at this shiny object. Look at this revenue juggernaut affiliate network that could plug all 100 plus of your clients into the platform. So we acknowledged what was the obvious, that they were buying us strategically so that they could move their clients that were on the link, mostly on the Linkshare platform at that time, which eventually was acquired by Rakuten. But so I knew EBITDA, I knew I had to get my narrative down. I knew that, which is interesting, I knew that we had to go into the transaction lean. So I took the opportunity, since I was preparing for an exit from the first day that I created the company, I knew that we had to cut some fat, you know, and I say it that way so that folks that are listening could really just honestly cut through the noise and focus on what matters. And so I identified poor performing lines of business, and we did away with them. So we went into the GSI Commerce transaction with a finely tuned profit margin, a much higher EBITDA than we had, you know, if I didn't do anything. And we were, you know, obviously we got the sale, and as they say, the rest is history.
The rest is history.
But in your case, Mr. Button, can you share an example where a seller misapplied the wrong valuation multiple?
Yeah, so almost every seller that I've ever spoke with wasn't clearly informed on how multiples or valuation multiples work. They were more on, I want $1 million. Give me $1 million check. I'll leave right now. Cut me a $5 million check. I'll leave right now. And it depends on how.
In your line of business, you've acquired a lot of like multi-generational, call them family businesses.
Yeah.
Right?
So a lot of them weren't super informed on that stuff. But the biggest issue that I see with unprepared sellers, or I don't want to say uneducated sellers.
Listen, most of them just haven't prepared.
Yep.
And,
yeah,
you know,
unprepared sellers. There you go. So mostly unprepared sellers, they are emotional. They listen to everything that is going on around them. And they might hear, X, Y, and Z company sold for 10 times EBITDA. Well, okay. Well, X, Y, and Z company might have had 30,000 customers on a 5-year contract basis, and they can justify that sale price. Or their uncle heard it, their cousin heard it, and their aunt heard it, and it went from 4 times to 6 times to 10 times by the time it actually got to them. It's all rumors. So the biggest issue I see with misinterpreted multiples are people not being ready for the market to delegate what they're worth, and then they get let down. They come in saying, I've heard, they use 5 to 7 times. 5 to 7 times is the average EBITDA. Well, the average EBITDA multiplier for a company consists of somebody north of $4 million. As soon as you're below that $4 million, then instantly your prices drop, your multiples drop. Because the durability isn't there. It's not a larger business. So the biggest issue with sellers is they get let down when the price discovery happens in the market and the bids come back on their business lower than what they expect. And that's really, it's hard to get over because you get into this mindset, I'm going to sell. Then all of a sudden you got yourself so built up and so worked up, then all of a sudden the numbers don't come back good. You're like, oh shit, now I gotta go back to work. You're out there buying a boat, buying a beach house, doing all this stuff. And that really hurts what they're trying to accomplish when they get emotional about it. And one of the best ways to do it is looking at industry comps. And the question for you is, how do industry comps how can founders use industry comps responsibly without overvaluing their business?
So let's start with something that's really important. Yeah, it sounds like I might be beating a dead horse, but for those that are listening, this question is why building a team that includes an M&A advisor, that includes an attorney with M&A experience, that includes an accountant or a financial manager with M&A experience. So if you have those people on your team, that's one of our most important jobs as M&A advisors, is to do the comprehensive market research, looking at similar deals. I like to say, think about it, because most people understand real estate transactions quite well. Most people either own a house or thought about buying one. Well, guess how they come up with your house valuation? They look for what they call comps. So other houses similar to yours in your market, right? Well, in the world of M&A, there's a bunch of things that impact it. So what I would say is, the industry timing is critical. If you're in a really hot M&A market, your multiplier could go up, honestly, 2-3 times on a traditional business. And on a tech business, we all know that Instagram, which was a great acquisition by then Facebook, now Meta, they paid $1 billion for basically a pre-revenue company. But that's the interesting thing about strategics, is that the strategic is, in my tech world, is almost always willing to pay more.
And didn't Google offer Zuckerberg $1 billion and he said no?
Correct. Actually, Yahoo did. Yahoo made an offer, Jerry Yang, the original founder of Yahoo. And then Sergey and Larry came in from Google. But anyway, so what I would say is, make sure you build out your team, make sure you listen to podcasts like this and read the books. And the other thing is, it's this multiplier is it's not static. When Ed and I have clients, we'll usually just by default give them a range, because we would never want to say, you are a 6-time EBITDA company. We would say, depending on the growth velocity and other aspects of the business, their preparedness for this exit, depending on the size of the company, how quickly the revenue is growing, we'll move up what would be a 4 to 6 time, multiplier. And I might move that up to 5 to 8 or 6 to 8, but it's all based on analysis. So short of you being able to do that analysis, short of being able to do the analysis, you have to have that team built.
So now we understand how the math works, but what makes buyers actually want to pay more? Coming up in segment 3, we're breaking down the levers that drive higher valuations and what you can do today to move the needle.
All right, so now that we know how valuation is structured, let's talk about what actually moves the needle. What makes a business go from 4x to 7x? It's ironic that our last segment ended the way it did. And because moving from 4 to 7 could be the difference of millions or tens of millions, or depending, hundreds of millions of dollars. But what makes buyers lean in and pay a premium? Man, this is a good one. Some of the things we're going to chat about here are growth rate and the predictability as value drivers. Definitely buyers want predictability and transferability. The power of recurring revenue, I know you love that, so do I. And the profile of your margins, how much profit you're making on your gross revenue. The team quality and scalability, it's the thing that we've talked about in previous episodes, and we'll continue to talk about how important that is. Buyers want to be able to take your team and then be ready on day one. Strategic alignment with the acquirers, similar to the story I just told about GSI Commerce, where I knew what they wanted. So I aligned with that. I sold the sizzle, and I knew they wanted the sizzle. And then finally, brand equity and defensibility of market position. So let me ask the first question here. What should founders be doing right now if they want to build toward a higher valuation in 2 or 3 years?
Get lean, number one. Get clean and lean. Like you said earlier, get rid of you don't always have to raise margins to earn money. Sometimes you just have to stop losing as much damn money. So if you have underperforming departments, underperforming product lines, get rid of them.
This is what in the previous segment and in the book I call kill the dead dogs. I know that sounds terrible, but you got to find the dead dogs and get rid of them.
And just think about it. You might have this really cool, flashy, high-profile business that's sucking $500,000 to $1 million, $500,000 to $1 million out of your EBITDA every year, but it's one really close to your heart, and you're like, oh, I really like it. And I've been there before. I've had it with a couple of departments, and I was like, I really like it, so I want to keep it. But you need to put that stuff to bed, because instantly, without raising a price and only removing the underperforming department or product line, you instantly just made between, say, if it was $500,000 and $1 million more by literally doing less work. So just think about that. You are overseeing all these departments and products, doing a bunch of work, and you say, I'm going to do less work and make more money, because now you're going to keep hold of your profit producing lines of business. That's number one. Make sure you're clean, make sure you're lean, and even on the employee side, if you have an underperforming employee that is sucking money out of your business from a salary side,
or air out of the culture,
or out of the culture, sucking your culture out of the business, get rid of them, move on, deal with it later. It's the first thing. Is then to really drive the value is to really lock in the revenues. So figure out a way to implement subscription-based approaches into your business or contractual agreements into your business, because the longer you can guarantee that revenue for that customer through a transferable agreement to the buyer, the more they're willing to pay, period. I mean, if somebody comes to you and says, hey, all my customers are month to month, I never know who we're going to have next month, they're going to be looking at maybe 12 months of your profit. But if you come to them and say, I got 10 years worth of contracts, they're going to say, well, shit, maybe we can get this one for 8 times.
You know what was crazy about the GSI commerce business that was just so attractive? One of the things that Michael Rubin did with that was he locked down distribution, like e-commerce distribution and e-commerce sort of infrastructure for all of the major sports teams, like I mentioned. And he was announcing 10-year and 15-year agreements, which are unheard of. So that's the extreme case. But to your point, you're saying that having reoccurring revenue as well as longer agreements could make the buyer more confident, and it could increase the multiple.
Yeah, so question for you.
Yeah.
What should founders be doing right now to really, really build toward their higher valuation in the next 2 to 3 years?
Yeah, I mean, so I talked about, and you just mentioned this idea of getting lean. You don't want to stop your growth factor, because remember, this is key, that a M&A process is a dance. Often it's a flirtation that turns into a date, that turns into a pretty intimate relationship, and then you're freaking married. And so depending on where you're at, is growth more important than lean? It's a tough question. But the reason why I use, kill the dead dogs and, cut the fat is really just to jar the entrepreneur, the founder, into exactly the advice you gave and I've mentioned in the past, which is run a great business. Because at the end of the day, if you make those hard decisions before the transaction, you're going to get a higher multiple. You're going to get through. There's no such thing as breezing through the M&A process. It's rare. It does happen. But you're going to have much more leverage. The other thing I'll say, Ed, is I think it's really important for entrepreneurs to think about their business model. And so when they're thinking about, are other businesses in my niche or sector being acquired, and for how much? Is it hot or not? I think it's a great opportunity when they're thinking through that to say, is anybody innovating in terms of the way they make money. So are they introducing subscriptions? I remember talking to you a year or so ago about some of the things you did at Button Oil. You know, when you bought that from your family, you know, it was only doing 2 or 3 million gallons of product a year, and now you have it up to what, 150 million.
Yep.
Well, one of the ways that you've done that is most recently through referral marketing, affiliate marketing, which is just brilliant, basically lighting up. And by the way, guys, all oil and gas, regional, family-owned oil and gas companies aren't as innovative thinking as Ed. He was like, how do I get reoccurring revenue? You know, how do I empower my customers to become the sales force? So these are the kind of things that I would recommend to an entrepreneur. And again, I use the word revenue juggernaut because I want you guys to be dreamers. I want you guys to think so big about the possibilities. Do not cap your ability to see what you want or to see what's possible. You know, it's one of those things that a lot of times people don't get a second shot. And so, you know, get your psychology right and dream big, and, you know, take notes on, you know, what it is that that Ed and I are talking about, because we've both seen a lot of deals. We've both been on both sides of the transaction. One final question for you is on leadership. So how does the strength of a leadership team factor into the offer price? Or is it more confirmatory? Be honest. Is it confirmatory, like pass fail? Or is it like, wow?
It really depends on the product and the business and the buyer. Again, financial buyers, they're going to put a lot of diligence on that team. They're going to purchase your business, and they're going to make the seller do retainment bonuses of you stay around for X number of years or months, whatever it might be, to make sure they can ensure they're going to make that money. But the team is super key from the aspect of a lot of times buyers don't want to only hear from the founders. They want to hear
so it de-risks them on the founder dilemma of everything runs through the founder community.
They want to de-risk themselves because they want to know that the founder's culture has spread through the whole team. The whole team is on the same page. Now, they might not agree on everything, but for the most part, they have the same goal. I mean, one goal that we set in energy is you are here to solve customers' problems. Customers are here to give you money. Just figure out a way to solve the damn problem and take their money. Don't ask them questions. Don't do this. Just say, okay, yeah, no problem. We'll figure it out for you. You're a fuel solutions provider, not a fuel provider. So it doesn't matter where you need fuel, whether it's Pennsylvania, Florida, New Jersey, whatever it might be, we'll figure out a way to get you something. So having that culture and having that mindset of we never say no, we only solve problems. And that's what, when buyers come in and say, man, this team's really all rowing in the same direction, they get it. Especially for a financial buyer, they're entrusting their capital in your business to make the return that they expect to come. And once all that's put to bed and they can trust your team, the sale process goes so much smoother.
All right, so we've talked about the fundamentals. We talked about how buyers think about valuation.
Yep.
We talked directly to our audience about the idea of how multiples or multipliers work, and it really depends on your business and it depends on your story, you know? In the final segment, I actually love segments where you kind of debunk myths.
Yep.
So what we're gonna do is we're gonna debunk some of the most common myths in segment 4.
So let's bust some myths, because too many founders walk in negotiations thinking they're worth a number that simply doesn't reflect the market. Segment highlights today is, I heard so-and-so got X, so I should too. I'll just wait until we're bigger for a better offer. The danger of setting expectations based on top-line hype, emotional attachment versus market-based logic, the myth that valuation is permanent or guaranteed. is the main things we're going to go over in this segment. So question for you, Kris. How can founders stay grounded in valuation conversations without underselling themselves?
So just a quick sort of analogy. We talked earlier in a previous episode about this idea of an athlete, how they prepare. The coach says, prepare on the practice field as if you were playing on game night. There is something special about game night. And so when you're in the M&A process, which is the equivalent of game night, you better be prepared, right? So know your numbers cold, like legit, like know your numbers cold. Be able to articulate both a look back and a financial analysis type of approach, look forward, that builds confidence. Don't inflate and don't lie, don't posture around vanity metrics. Be honest. Don't be afraid to sell the sizzle. That's, I think, where sellers are gonna get the most value, and so that they don't undersell themselves, is in being able to tell a narrative that's super, super compelling. And if they do what we said in this episode and in the previous episode, I think they're going to be in good shape. But again, what is practice? For an athlete, it means showing up and working hard. What does it mean for an entrepreneur who needs to prepare for an eventual exit? What it means is reading the latest in the financial sector with regard to deals happening in your industry. When you go to the conferences and you're trying to sell, which is cool, take 10 or 20% of that time to schedule some strategic meetings, not only with people that could buy your company, but people who've been through the process, so that you could pick their brains, ask them about the pitfalls, ask them about the common myths. And the other thing is, confidence and humility go hand in hand in negotiation. Don't be afraid to talk about some of the struggles, to be a bit vulnerable and talk about some of the struggles that you've had. But you can only self-deprecate so much before you're a clown.
Yep.
You need to be able to build a spine and build what Tony Robbins calls absolute certainty in your future. Don't spend too much time on the past. It's important, and you're going to have to do that. But when you're in control, when you're leading the conversation, when you're in a point of leverage, sell the sizzle, sell the future, and sell it with confidence.
That's why your windshield's bigger than your rearview mirror, right?
That is absolutely true. I love it. And so a quick question for you is, how do you help sellers reset valuation expectations when they're unrealistic?
That's tough. It's extremely tough, because this is somebody's child, their life work, their blood, their anything, any type of saying you want to put around it. This is their
baby.
Their baby.
Yeah,
it's
a child.
So having to talk them off of, and some of them are very reasonable, but having to talk the ones that aren't reasonable off the ledge and get them to understand what their business is actually worth is tough. So a lot of times we'll lead with ranges, market research, prior transactions we can confirm. You never want to go with a transaction you can't confirm, because you don't want to have it go the wrong direction. The private industry is very hard to do that, because a lot of times it's family to family to bank, or family to capital, whatever it might be, or family to another company. So everything's hush hush. But there's a lot of statistics out there that are able to help you get very close within a range of 1.5 to 3 multipliers. So whether it's a 5 to 7 or a 4 to 6 or a 4 to 7, kind of give you a range, a high and low. And we've been through them before, where you do a valuation and you get a range and your first offers come in at 1 or 2 times above the high, or they come in 1 or 2 times below the low, and you're like, son of a bitch, what the heck happened?
This is what the market's telling us.
Yeah, and in the end, always leading with the caveat of, the market will delegate what your company is worth. If you're willing to accept it or not, that's up to you. But we're gonna go out, we're gonna go into a full price discovery to understand what the strategic and the financial buyers are willing to pay for these businesses. And we're gonna come back to you with a bunch of different options that will allow you to pick from whatever buyers you like, whether it's you don't like this buyer because they might have taken a customer off you or this, whatever it is.
Yeah.
You can go out and pick from them. Talking them off the ledge is key, but how do you explain to a buyer that sometimes waiting until you're bigger is not always the best strategy for higher valuation?
So I actually think that if you do what we say, which is to do the market research, ask lots of questions so that you empower yourself, you'll actually know when the market's hot. And by the way, news alert, I don't even know if this is an opinion, but it's definitely my opinion. The best time to sell is when the market has a lot of buyers. Because if you have a lot of buyers, the process that M&A advisors like legacy advisors love is when there's lots of buyers who want our clients.
Or your competitive bid.
Yeah, you basically drive up the value and the end exit price by having lots of options. And of course, in a competitive situation, we could use that to our clients' advantage by getting LOIs in quicker, getting prospects that put in a bad LOI to potentially reconsider, et cetera. And I think there's an illusion with numbers. There just truly is. But the reality is despite what you hear, bigger is not always better. Think about it. If you're a $100 million company that isn't profitable, or you're a $75 million company with 25% margins, the two aren't even close. You're going to get a much higher exit value on the more profitable company.
Yes.
Without considering all variables. Of course, there could be situations. The other thing is, and I get it, you have to balance top line revenue from net profits. It's a bit of a dance. I mean, you do want to pay attention to it as a CEO or as a founder, but you also want to make sure that that you're growing that bottom line number. And again, it's this, in the tech space, it's this wonky balance between growth,
Margin.
or what Reid Hoffman, founder of LinkedIn, managing partner at Greylock Ventures, who invested in one of my startups, actually Reid Hoffman did, what he wrote a book called Blitzscaling. So in the tech space, those Silicon Valley VCs, they don't want to just see, oh, look at this $25 million company on a 40% margin that was $22 million 3 years ago. They're going to look at that and say, not too interesting. But if you're a $25 million company and last year you were 8 million and you're projecting 60 million, the difference couldn't be more clear that you have implemented the revenue juggernaut and you are a rocket ship. Reid Hoffman and other Silicon Valley venture capitalists are going to want to give you money to go from zero to hero. Let me give you a quick example. So the way that the VC model works in the tech space is they'll often want you to constrain your audience when you're in the process of achieving product market fit. So you see a lot of companies who launch in a singular market. San Francisco's popular. You see, most recently, Elon announced, and they're rolling it out right now in Austin, Texas, the autonomous driving. What they want to do is they want to give their product or service to someone. They want to collect data. They want to improve the product before you do what Reid Hoffman wants to do and blitz scale. So it's just something to think about. Bigger is not always better. Strategic is always better. Growth velocity in the tech space is always better. But if you're selling in a more traditional space, that bottom line is going to matter more than anything.
And they want ROI.
And I've already mentioned the importance of timing. But listen, that is a wrap on episode 8, Valuation 101. I hope that you guys were able to get some value from this. If there is one big takeaway for our audience, it's this: your business is worth what it's worth to a specific buyer at a specific time, and your job is to build toward that outcome intentionally.
Exactly. Don't guess, don't assume, prepare, lead with data, and when the right opportunity shows up, you'll be ready to have an exit.
Make sure to subscribe on YouTube and on all the social channels. We're doing our best to stay active there because we want to engage with people. And in the final thing I'll say is thank you. Thank you to the dozen or so people who've reached out to Ed or I with emotional messages. One founder in particular, this is a gentleman who is a multi-millionaire and has sold multiple businesses. He said, Kris, if only I was able to listen to your podcast before my first exit. We'll see you guys next week.